Hello, and welcome to our series. Do you really think you are financially secure? We frequently confuse ourselves that believing we are financially secure. Most people, especially high earners, have a nest egg which provides them confidence. However, this may not be sufficient to meet all of life's requirements. We will unpack specific needs and how to satisfy them in this series. I'm RJ Vasudha Deshpande, a financial services professional based in Cincinnati and Northern Kentucky region. Yet, I serve clients throughout the United States. And with me today, I have three experts in this field. Today, we are going to talk about disability and its impact on financial planning. Disability could affect us anytime, and when it happens, it could be disastrous to our financial well being. In this episode, we will focus on understanding how to address this roadblock and preserve our wealth in this dire situation. In our previous episodes, we covered life and how to protect what we love. And we also discussed retirement planning, but never covered what is disability and coverage in detail. So, let us start with introductions first. Shishir, let us start with you.
Sure, Vasudha. Hello, this is Shishir Rege. I'm a financial strategist with Anant Wealth Solutions. I specialize in tax diversified retirement planning and financial protection for families and small businesses. Just like Vasudha, I'm physically located in Greater Cincinnati, Northern Kentucky area, but I work across the United States. Over to you, Bhavin.
Hi, everyone. This is Bhavin Shah. I'm a financial professional and I help families by educating them on financial stability in any market condition, tax-free retirement income, guaranteed lifetime income, and with their with their estate planning needs. I'm located in our beautiful Northeast, but have clients and teams spanning all the way to Florida and California. Over to you, Shams.
Hello, my name is Shams Pirbai. I've been in the financial industry for about 2 decades now, my focus being auto insurance and life insurance. I'm based in the great state of Texas, living with my family of 2 kids in San Antonio. I love educating clients and families on how they can protect their today and tomorrow. Back to you, Vasudha.
Thank you all for your introduction. So, Shams, let us start by defining what disability is. Can you paint a picture for our audience?
Sure, Vasudha. Now visualize yourself getting up from bed one day, going to the restroom, taking a shower, getting dressed, having breakfast at your breakfast table, and walking to your car. Did you do anything extraordinary this morning? Probably not. But if you cannot do any of the two things just mentioned, now that is known as disability. Defining disability is formally when a person cannot perform any two tasks of daily living, that is, bathing, eating, dressing, transferring, toileting, and moving around or walking by yourself without assistance. Guess how much health insurance pays if you get disabled? Nothing. Health insurance pays for your hospital bills after you've paid the deductible for needed surgery or expenses such as visiting a doctor, physical therapy, or any prescription drugs. Now, a critical point that I cannot emphasize enough, that is a lot of people believe that disability can only occur when we are old, and I can prove that that is a wrong assumption. Now, the reason I'm so confident is because disability is something that none of us visualize happening to us at any time. And I was the same way. But in 2017, when my second child was only 3 months old, I was diagnosed with stage 4 cancer. So this all became a reality for me in an instant. Now, another type of disability could be severe cognitive impairment that necessitates substantial supervision. Example could be dementia or Alzheimer's disease. Hope that helps. Back to you, Vasudha.
That is really shocking to hear, Shams. And thanks for sharing your personal experience of disability with us. Now, Bhavin, let us talk about the impact of disability on our financial house.
Sure, Vasudha. There are two pieces to this puzzle: impact of disability on our income and impact of disability on our expenses. So let's talk about impact on income first. So once a person is disabled, they cannot work, and that means their income usually stops. Folks may have disability policies through work, such as short-term disability, long-term disability. But for those who do not, and if they are disabled, then they cannot work or maybe work, right, but in limited capacity. In such a case, the income vanishes or significantly reduces. But their expenses, like mortgage, card loans, household expenses, other liabilities, and their responsibilities continue. So this is one of those storms, that we need to plan for and hope it never comes. Along with regular expenses, there will be added burden to the family due to this disability. So, discuss the magnitude and impact of these expenses. Let me hand it over to Shishir.
Thanks, Bhavin. So, due to disability, since a person cannot perform certain activities of daily living, their spouse or someone else in the family would need to help take care of them or assist them with those activities. So, let us assume that the spouse or another responsible adult in the household is helping with the daily activities due to this person's disability. Now, mind you that this person has already reduced or lost their income. Now, this would also mean that the other adult who is taking care of the disabled person may not also be able to earn their regular income, which means that there is a further impact on family's income. Okay. But if there are no family members who are physically able to help the disabled person, or they need to get outside help for any reason, then to get outside professional help, for example, a home nurse, or even admitting a disabled person to a nursing care facility or some combination of that, then this additional expense becomes the family's liability. And as Shams mentioned earlier, this additional expense is not covered by health insurance. If the individual is eligible for Medicare, then Medicare only covers for up to first 100 days of such care per calendar year. The cost of such external care could range between $15,000 to $100,000 a year, or in some cases even higher, depending on the person's condition and assistance required. These are the additional expenses on top of regular monthly expenses you would have. Okay. Back to you, Vasudha.
Thanks for sharing impact to income and expenses due to disability. Shams, can you elaborate of what could happen to this family if the primary earner is disabled?
Sure, Vasudha. As Shishir mentioned, a single incident of disability care related expenses could range anywhere from 15,000 to 100,000. Now, it is likely, since most families would not have that kind of emergency fund, they would tap into their savings and retirement accounts. But one should be aware that taking money out of a retirement account has penalties associated with it, and also potential tax liabilities too. It becomes somewhat immaterial if the family first withdraws from their savings or retirement accounts if the disability continues beyond what they have saved. The next option for many families is to turn to something like a GoFundMe page because bankruptcy starts becoming a reality after all options are exhausted. No matter the scale of disability related expenses or the duration of disability, it does leave a dent, either big or small, in one's saving, retirement planning, and income. Over to you, Vasudha.
Thanks, Shams. It would be really tragic to have all the hard earned wealth, which families work day and night to build, and for that wealth to evaporate within a short duration due to disability. So, how do we handle the risk of disability, Bhavin?
Sure, Rosudha. That's a good question. So, when we talk about risk mitigation, right, there are three options. One is transfer the risk to someone else. Second is you own that risk. Or third is you completely avoid it. So, disability does not necessarily happen due to controllable events, right? So, we cannot really avoid it if it happens. So, we only left with two options. Shams already explained that if we do not transfer the risk, we own the risk, and has already spoken about the impact of not transferring. So let's talk about, right, disability as a risk which could be transferred. And then there are insurance companies to which we can transfer this risk to. Now, there are multiple types of policies out there. Example, disability income policy, disability expense policy, and there's yet another policy which is by adding riders to life insurance policies. So let's start with the disability income policies. So many employers offer disability income policies as benefit of employment. Typically, employers provide two types of disability income policies, right? The short-term disability and long-term disability policies. The short-term disability policy could range from like a few weeks, right, to up to 6 months. It's entirely dependent on an employer and could cover, up to 100% or any reduced amount of income, say 60%. So when disabled, an employee does not really get a paycheck. The group insurance policy, which the employer has purchased, pays the employee on a weekly basis. Now, after that short-term disability period, if the employee is still disabled, they would typically qualify for the long-term disability income policy. The payment the employee receives could be 50%, 60%, or sometimes even actually lower, as most long-term disability insurance income policies do not pay 100%. The duration of the coverage is limited to and could be capped out at 2 years. A word of caution here, right? When disability, especially during the employee's long-term disability phase, that employee may not be considered as an employee and hence may not be entitled to health insurance or life insurance that the employer offers. Right? So one should definitely check with the employer's HR department on what those conditions are. Now, most families have expenses which almost equal to their disposable income. Right? So the payments from short-term and long-term disability, because they're reduced, would barely help in keeping up with those daily expenses, and usually won't be enough, right, to reduce any expenses which they could execute. So due to the reduced nature of the employer-provided disability income policy payments, it is likely that not all expenses may even be covered, and one needs to be mindful of that. A key point to note that this is group insurance policy. That means that this is only available to you when you're part of that group. We spoke about folks who are employed, but for those who are self-employed, right, business owners, they can purchase these disability income policies outside of that group setting as well. A couple of points to note there, though. Usually there's a limit to the amount of disability income coverage a person can purchase when shopping for a non-group disability income policy. There's also a clause about a person's own occupation versus any occupation. Right? Let me hand it over to Shishir for policies which could be taken care of for disability expenses.
Thanks, Bhavin. So, as the name suggests, the disability expense policy, or what we call disability expense policy, is to cover disability related expenses. Okay, there are two primary ways to get a disability expense policy. So you're transferring the risk of disability expenses to the insurer. One way is what we call a long-term care policy, also known as LTC policy. When you purchase a LTC policy, you need to know how much it would cover and what is the waiting period. The LTC policy could provide coverage for preventative, diagnostic, therapeutic, rehabilitative, even personal care services that are provided in settings other than hospital or acute care units or outpatient units. LTC policy could also include benefits that cover expenses related to care in a nursing home, adult daycare, extended care facility, home care, personal care, so on and so forth, including even hospice and respite care. The second way is to ensure that your life insurance policy has a chronic illness rider. Okay. A chronic illness rider is a part of accelerated death benefit riders. And don't worry, we will talk about those in a minute here. Some insurance companies may also call it living benefits rider. So having this rider on your policy allows you to accelerate portion or full applicable amount of death benefit to pay for any expenses. Activating this benefit does not require you to provide proof of expenses, which is different from LTC, but the death benefit and other policy values would be reduced. There could be cost to add this rider to your policy. So you should check with the licensed insurance professionals like us to get an appropriate policy. So, similar to LTC policy, there could be a waiting period to activate this rider as well. Now, there are few key points to note here, and they are applicable to both types of disability expense policies. There is an IRS per diem limit on annual benefit payout amount. To activate benefits under these policies, a qualified health care professional must certify that the person insured is disabled. There is usually an ongoing recertification requirement, and that is, I think, typically annually. So this point is especially applicable to LTC policy. As mentioned earlier, there is typically a waiting period before the policy starts paying the benefits. Generally, longer the waiting period, lesser the premium for the given benefit. So back to you, Vasudha. Hope that helps understand the impact of disability expense policies.
Yeah, thank you both for explaining the income and expense types of disability policies. Shams, my next question is to you. Shishir mentioned that chronic illness is a part of accelerated death benefit or living benefits riders. What are the other living benefit riders?
Great question, Vasudha. Let me first spend a minute to explain the concept of accelerated death benefit, or also called living benefits, of a life insurance policy. Typically, people think of a life insurance policy in context of payments to survivors, which means the only benefit of having life insurance is if they pass away, the survivors get a lump sum death benefit, which is tax free in most cases. So, accelerated death benefit riders basically are provisions in the life insurance policy that allows an insured to use some or all of the death benefit portion of a policy while they're alive if certain conditions are met. There are generally three types of accelerated death benefit riders. Please note here that each insurance policy is different, and not all insurance policies have accelerated death benefit riders, or could only have some of the accelerated death benefit riders. So let's talk about the three common ones. First is terminal illness rider. With this rider on a policy, if the insured is identified with a terminal condition, which means that if their remaining lifespan certified by a qualified healthcare professional is under 24 months, 12 to 24 months, then by activating this rider, one can accelerate the death benefit portion of life insurance policy, and that money can be used for any purpose necessary. In most cases, however, once this clause is opted for, the policy is closed out after payment. This may help pay for medical expense or to take care of responsibilities prior to one's passing away. The second kind is the critical illness rider. With this rider on the policy, if the insured has a stroke or heart attack or anything happens to the insured from a list of things by insurance company, which involves hospitalization, then the critical illness rider can be activated. This rider is to offset the sudden and unplanned expenses that would arise due to the illness and thus protect your savings and retirement account. This rider can be activated multiple times during the duration of a life insurance policy, but only once per illness. Now, the third kind is the chronic illness rider, and Shishir has already explained, so that I would add only one more point for critical illness rider. Although the rider is called a chronic illness rider, it does not mean this rider allows activation for all chronic health conditions. For example, if you have a cardiovascular disease or diabetes, unless these conditions are cause prolonging interruptions in the activities of daily living, they would not be covered by this rider. Back to you, Vasudha.
Yeah, those are very intriguing definitions. Bhavin, in anticipating this question coming from our audience, I would like to ask you to why their health insurance would not cover chronic and critical illness related expenses.
That is a great question, Vasudha. So, what we call health insurance is a combination of three types of insurances, namely hospital care, physician care, and prescriptions. So, any required hospitalizations and related treatment, operating expenses, and medications could be covered by health insurance up to a certain point. So if you notice, most health insurance do not even offer coverage for dental or vision care beyond maybe preventive checkups. During a critical illness event, what is potentially not covered is some of the cost of ambulance or like the first line of treatment, copays, co-insurances, deductibles, and so on. This is where critical illness accelerated death benefit rider is very useful, right? So for chronic illness related expenses like nursing care, right? There's a home care, it could be like anything else which is not covered by health insurance, as the care is not provided in the hospital. Right? Shishir mentioned this in urgent care, outpatient settings. Then the need for chronic illness accelerated benefit rider is also there to cover these expenses. So back to you, Vasudha.
One last question before we end this topic. Shishir, this is for you. What are the other types of disability or similar types of policies available?
Sure, Vasudha. So far, we discussed policies which cover different types of long term care and income replacement policies. One can buy specific coverage for specific diseases as well. So I can give a couple of examples. The list is huge, but a quick example is a cancer policy. This is recommended if your family has a history of cancer. So if the cancer occurs to you, then you have that cancer policy triggering and covering for the cancer related expenses. Some people, instead of buying a long term care policy, they prefer buying a nursing care policy. So this covers most or all of your expenses when you are admitted to the nursing care facility. There is a whole list of other special policies, and we can help our audience with finding the right solutions if that is right for them. So back to you, Vasudha.
Wow. Thank you again to all three of you. That was a lot of great information and another wonderful session. We have checked off overcoming one more roadblock on the way to financial freedom for our audience. Love to hear from our listeners. You can write to us at info at anant-wealth.com. All our episodes and contact information can be found on Bharat FM's Facebook and YouTube channel. Stay tuned for our next exciting episode where we will discuss an overview of annuities and how it can be valuable tool in your retirement planning. Until then, thank you all for listening. So this is RJ Vasudha over and out. Thanks.
Thank you.
Thank you.